Okay. Good evening. Let me welcome you to our webinar on activity-based cost management, making it work. We are very happy to have with us our fellow member. He's a fellow member of the Institute of Certified Management Accountants of Sri Lanka. We were indeed honored to grant him the fellow membership, and Mr. Gary Cokins is here with us. He's been doing a number of webinars for us, and also wanted to restart what for this year to a new series that we have worked on. So today we also have some special guests whom we have invited, especially that they will be able to listen to Gary and also may be able to clear any doubts that they have. So we have our council members, Mr. Manil Jasingha, and as I said earlier, the president partner of Ernst & Young and a council member of CMA Sri Lanka. Then we have Professor Harendra Karyavasam, also our council member and the Dean of the Faculty of Accounting of the University of Sri Jayawardhanapura, the main university that is involved in the accounting and business subjects. Then we also have from the university, that is from the Colombo University, Professor Chandasri Abesingha. He is the professor in accounting in the Colombo University. Then we have Dr. Nuwan Gunratna, senior lecturer, our own member, who I think you know very closely, and is one who really introduced you to CMA to start the lectures, a senior lecturer and working very closely with our CMA. Then we also have our acting CEO, Mr. Kosala Disanayaka. Then let me also welcome all our members of CMA Sri Lanka and the other participants at this webinar today. So if you see, you can see the book, Activity-Based Cost Management, Making It Work. I think you will all should know that this is a publication of Gary Cokins. He's been publishing number of books, but this is one of the main ones on the activity-based cost management, making it work. So I don't want to speak too much, but I just want to tell you that we've been having a number of webinars relating to the costing area. Last week, we had one on the electricity sector. Now there, the Utilities Commission, which is the regulator, has stated that the electricity pricing should be should use a cost reflective methodology. So maybe I was maybe thinking that this might be our activity-based or ABC management or activity-based cost management can be used, especially for this, because one of the things that we noticed was that in their generation units, there are certain plants which are very inefficient. The consumption of fuel is very high, the cost per kilowatt is very high. So these are areas I'm sure that we can use this. In addition to that, today cost is a major factor in everything, in all our industries, in all products, services. This has been due to the current economic problems that we have faced. One, of course, is the major reason of the high debt component of Sri Lanka. Worst, of course, is that we are unable to service it. Then also the depreciation of the currency, which has resulted in all the goods going up, the fuel prices going up, the non-availability of the foreign exchange. Now, I feel that many of these are connected with the cost. Because if we are borrowing, that means our expenditure is more than our cost. Our revenue is not sufficient. If our pricing goes up, that means our cost is going up. Then how can we reduce the cost? How can we do saving, the efficiency, cut down the wastage, improve the productivity? Now, these are all connected with the cost accounting. And I'm sure that the activity-based cost management would be one area that we could make use. In many government institutions, when we look at the direct costs, they are very few or maybe insignificant. But when we look at the indirect costs, they are really the main cause of some of the high costs, the high expenditure of the government as a result of these indirect costs. So cost is very essential, and this was stated in the Committee of Public Enterprises report in 2040, where they said that there are a lot of state institutions that are losing heavily. They are not looking at the costing area. The costs are very high, that they should have cost accountants in all these organizations. And they said that the Treasury or the Ministry of Finance should look into this and implement. But unfortunately, these have not been taken into account, and today's difficulties, the problems that we have faced, would have been to a great extent reduced if at that time in 2014, they took these decisions to get the involvement of the professional management account. So with my introductory remarks, I would like to, as I said, that we have Dr. Nuwan Gunratna, I think, who has been closely associated with Gary Cokins. So I will, Dr. Nuwan, I've already mentioned that I think he was in Australia at that time when he made contact, and now he is back with the university. I will now invite Dr. Nuwan to introduce Gary, because he is someone who needs, although he needs no introduction, I think we have to introduce him in order that all of them will know the great work that he has done for the cost and management accounting profession. So over to you, Dr. Nuwan.
You're muted.
Yeah. All right. In fact, Gary, when Professor Wattavala invited me to introduce you in today's webinar, one thing he mentioned was that make it short, and then Gary and the participants will have the maximum time to interact. So, as Professor Wattavala mentioned, Mr. Gary Cokins is no stranger to CMA Sri Lanka if you have participated in any of the previous webinars organized by CMA Sri Lanka. I think, if I'm not mistaken, Gary, this is your 7th or the 8th webinar. So also I need to emphasize that these are all the webinars these are all free webinars that Gary conducts, because he now he wants to give back to the society. So Gary has been for over 40 years. Gary has been recognized as an international renowned expert, speaker, and author in performance measurement systems and analytics and advanced cost management. So he's the founder of analytics-based performance management and advisory firm located in North Carolina. Talking a bit about Gary's educational background, he received his Bachelor of Science degree in honors in industrial management and operation research from Cornell University in 1971. Then again, he received his MBA from Kellogg's School of Management in 1974. Then in 1981, Gary began his management consulting career, first with Deloitte. Then he was trained on ABC by Harvard Business School professors, famous professors Robert S. Kaplan and Robin Cooper. While at KPMG, he worked with Dr. David Norton on research that led to the development of famous balanced scorecard. Then Gary has also served with Professor Robert S. Kaplan on International Monetary Fund's activity-based costing advisory panel. And also as Professor whatever I mentioned, Gary has authored many books. One book was that's on our background, that is activity-based cost management, making it work. And he has authored several other books such as activity-based cost management and executive guide. Then again, activity-based cost management in government sector. Then again, performance management, predictive business analytics. Then again, strategic business management. So these are some of these books to Gary's name. Also, Gary served the Institute of Management Accountants in USA as the IMA executive in residence. He contributed to research reports, then again strategic financial articles, then learning webinars, as well as providing ongoing support for IMA expansion, international expansion. So this list goes on, but due to the best interest of time, let me wind up my introduction and let me hand over the proceedings to Professor Vatavada. Thank you.
Thank you, Dr. Nuwan. So Gary, over to you now.
Okay, thank you. Let's test. Can you see my first slide?
Yeah, we can see.
Okay, great. Well, thanks again for inviting me to present and also for honoring me by being a fellow at the ICMA Sri Lanka. I suggest to the attendees, you may want to write my email address that's on this slide, gcokins@garycokins.com. There may not be time for Q&A, but you can directly send me questions, and feel free to invite me in LinkedIn. So yeah, who am I? Nuwan already gave the background that you see on this slide. I did graduate in 71. So if you're doing the math, I am 73 years old, but I feel like I'm 43. I feel like I'm a young guy. The reason the books are there, and that's a few of them, careers have a lot more to do with luck and circumstances than being smart and competent. And I had a lucky break when I did get trained by Professor Kaplan on ABC. I was recruited from Deloitte. I was there 7 years to KPMG. And after implementing ABC for 5 years, I wrote a book, which is the one you saw on the cover, and then more books. I did spend 16 years with SAS at the end of my career. I retired from them 8 years ago. And some of you may not recognize SAS, but it's actually the world's largest privately owned software vendor in business analytics and data science. So let's go. Oh, so this is about a 65-minute presentation, and we've started late. We have 90 minutes. I'll try to go through it more quickly so that there's time for 15 minutes at the end for either comments or questions. So who will benefit from this presentation? Managers who have previously struggled at promoting strategic cost management, financial planning and analysis, activity-based costing, and integrating business analytics into their decision support systems. Managers who intend to champion any or all of these improvement techniques and need a compelling call to action. And the reason I have champion in quotation marks is because it's been my observation that although it's nice if the senior executives sponsor or advocate progressive methods, often those executives are preoccupied with firefighting and short-term priorities. It's typically managers 1, 2, 3, 4 levels down in the organization chart who are passionate and ask themselves, how long do I want my organization to continue to perpetuate using stale and arcane and out-of-date methods? And they're the ones that'll do a pilot or a proof of concept to demonstrate to their co-line managers and executives, this is the way to go. So if you're 3, 4 levels down in the org chart, that's fine. I like presenting to you. I do like starting with these 3 questions. What, so what, then what? So imagine that you do successfully implement ABC if you haven't already, but very few have. I say celebrate for one day. You are not done. You and your organization will see much more information that they've never seen before, and some of it will be contrary to their beliefs. So that begs the second question, so what? What's relevant in all of this? But arguably the more important question is the third one, then what? Because all decisions are only made in the future. So instead of just looking backwards through the rearview mirror, last month, last quarter, we want to look forward, budgeting, planning, rolling financial forecast, what if scenario analysis. Now, this presentation is actually a portion of a all-day 8-hour presentation on enterprise and corporate performance management. But what I'm going to focus just in this 65 minutes is number 4, 5, and 6, the strategic use of ABC or of management accounting the operational for process improvement, and then the future view, budgeting and planning. Ruan mentioned that I did spend 3 years after I retired from SAS with the IMA, the Institute of Management Accountants in the US, as their executive in residence. I wrote many, many articles. A very popular one in their Strategic Finance magazine is this one. There's the links. You will receive a PDF of this presentation after we're done. As was mentioned, how did I get involved with ABC? Well, there's the photograph of Dr. Kaplan. He was contracted by KPMG to recruit or to train KPMG consultants. I was recruited from Deloitte. The rest is history. His big breakthrough book, co-authored with Thomas Johnson in the 1970s, Relevance Lost, The Rise and Fall of Management Accounting. That's where he began to explain ABC. This is the better book that I wrote. It's got a lot more information. Incidentally, I'm not promoting these books like I'm trying to sell you something. In fact, so I suggest don't buy my books, but go to Wiley, and chapter 1 is typically a free download. It'll give you a good overview. Now, I want to put in perspective a taxonomy that I created for the International Federation of Accountants, IFAC, IFAC.org. You may not be familiar with them. They are in New York City. They're like the United Nations of Accounting Institutes, I think 180 global. And I told them I can create a taxonomy like in biology, plant kingdoms and animal kingdoms. And here you see the 3 kingdoms of accounting: tax accounting, external financial accounting, internal management accounting. So let me drill down. For the financial accounting, after we calculate the costs from the expenses, for external financial accounting, we have to follow rules, generally accepted accounting principle. It's typically for valuation, cost of goods sold, inventory valuation. But the good news is for management accounting, we don't have to follow those GAAP, generally accepted accounting principle rules. We'll model it using different assumptions. And that gives us that historical view. But then we go to the predictive view, decision support, and cost planning. Now you notice at the bottom, I have the value spectrum, low value add at the left, and then the value of accounting information increases exponentially as we go from left to right. So when we do the historical cost reporting, but with more accurate information, better value, but the most value comes from the predictive view. So let's start with the first 3 of the 4 of the documents. Also, it was mentioned that government can also use these management accounting. And if you're interested, I did co-author a book with Doug Webster. He in the United States was the chief financial officer of our Department of Labor and Department of Commerce. And I have a link to the book. Activity-based costing is described in the book. So what's caused interest in ABC? Primarily mistrust of the managerial accounting system and its flawed cost allocations and misleading cost reporting of outputs, products, standard service lines, distribution channels, customers, and outcomes. The reality is most line managers do not trust the management accounting system because of those overhead indirect expense that was mentioned that I'll describe in a second. Now, here's part of the problem. Which managerial accounting system should you use in your organization? I'll let you look at this for 10 seconds. Even most cost accountants don't understand what the differences are between all these. But what's important is all of them comply with the causality principle, cause and effect relationships. I'll describe that in a few minutes. So let's put this into perspective. Direct costing versus indirect costing. The highest form of any costing is with direct costs. And what I'm showing here is a spectrum from the left to the right. The highest form is project accounting or job order costing. However, that only applies when there are non-repeatable processes or you're making a one of a kind, like a satellite, or in manufacturing, engineer to order, make to order. That's more complex timesheets. Traditionally, organizations do standard costing. And I want to mention that I know many of you may not be in a manufacturing environment, you're in services, and that's okay. In the United States, only 8 out of every 100 jobs make products. The other 92 deliver services, but costing is universal. Activity-based costing, I call it the poor person's standard costing system. It's actually easier to do than standard costing, although some of you may not believe me with that, but I'll explain that later. The real message in this slide is allocations to the right. Notice I've got a line through it. Bad. It's the last resort. We'll talk about why the problems are with cost allocations. And activity-based costing resolves the problem with cost allocations. And the easiest way to explain it is this. Imagine you go to a restaurant with 3 other friends and you order a little salad and the other 3 order the most expensive item on the menu. And at the end of the meal, when the waiter or waitress brings the bill, the other 3 say, "Hey, let's split this check evenly. How do you feel?" Not fair, not equitable. Well, that's how products and standard service lines in a service company also feels when in the general ledger accounting system, the accountants take this large amount of indirect expense, commonly called overhead, and they allocate it like spreading butter across bread using cost allocation factors like number of labor hours, number of units produced, number of employees in a cost center, square feet, square meters. None of those cost allocation factors reflect the unique consumption that the diverse products and service lines consume of the end-to-end business processes and the work activities that belong to those processes that draw on and consume the expenses. So if you were to decompose the indirect into multiple cost pools and trace and assign them using a cause and effect relationship, not butter spreading, you will discover that compared to that traditional butter spreading, in reality, some of the products and service lines were overcosted and the others must be undercosted because it's a zero-sum error game. And that means that the CFO and the accountants are providing flawed and misleading information to their line managers and employee teams. Oh, yes, it does reconcile in total for the auditors like EY, PwC, KPMG, and so forth, but it is wrong in the parts. So the simple explanation of ABC is as if the waiter or waitress brings 4 individual checks at the dinner table. You only pay for what you uniquely consumed. Now, the reason there's been interest in ABC over the last 70 years has to do with this slide. It has the 3 universal components of any organization's expense and cost structure. At the bottom, the direct labor, and I notice I use recurring labor because service organizations, they see direct, oh, this is manufacturing, it doesn't apply to us. No, it does. It's the employees doing the repeatable work. The material, and then the indirect expense. Notice that over time, the indirect expense is displacing the direct. And when you ask managers, why is this? They think, well, automation, computers, robots, we're automating the frontline workers. That is secondary. The main explanation why this displacement is occurring is over time, all organizations have had an increased proliferation of different types of products in manufacturing, more colors, more sizes, more ranges, in banks, more types of depository accounts, and insurance companies, more types of policies. The point is this: whenever you increase the diversity and variation of the outputs, it just creates complexity. And the complexity requires more and more indirect expense to manage the complexity. So 70 years ago, when the products were homogeneous and the majority of the expenses were direct, okay, you could butter spread the indirect. You wouldn't introduce that much error, but that's not the case today. You have to basically trace and assign. Now, the problem actually begins with this traditional monthly responsibility cost center statement. Every manager in the planet Earth recognizes this statement: salary, equipment, travel. But the problem is, when managers receive this report, they ask themselves, how much insight and understanding do I get about the cost that I can influence and control? And their answer is not much. I like to say when managers get this kind of report, they are either happy or sad, but they are rarely any smarter. And it's not that the report's a bad report, it's a good report. It's just that the data in this report is not structured to provide the answer. So what ABC does is it changes the structure. Notice the same 914,000 from the left converted into the language of work activities. In the middle, key scan claims, analyze claims. Notice I'm using the back office of an insurance company. It's a factory too. And then it reassigns each of the activity costs into the product, services, and customers, just like the waiter or waitress in the restaurant, based on a cause and effect relationship. So the reality is expenses do not actually start at the left side of this diagram. The expenses actually start at the right side of the diagram. The products and the customers and services place demands on the workload in the middle, and then the workload draws on the spending or the budget or the capacity at the left, and the costs measure the effect in the other direction. So I'll repeat that. The demands on work flow right to left, costs measure effect left to right. Rules are many, but principles are few. And the universal causality principle is like the speed of light or gravity. You can't violate that. It's a principle. Now I've rotated the diagram 90 degrees. It isn't as simple as, oh, we take our general ledger expenses, put them into activity cost pools and trace them to products and services. The right side of the diagram is more realistic. Why? Because you have support activities that support other support activities that eventually interact with customers or make products that pile up. So it must be a multiple stage cost assignment network. Now, I want to warn you, the next slide is going to look complex. I'm going to go through it quickly, but the good news is a slide after it, I will give you a link to where you can read about it at a slower pace. Oh, just real quickly, fundamentals on ABC. Notice we've got resource expenses at $70. Now going from left to right, 10 of the dollars is direct material. The next 10 is direct labor. Then we've got $30 of indirect support activities. Then we've got $10 that is customer related, and then something called infrastructure business sustaining. Notice if we look at the support activities at 30, we can reassign 5 of them is actually supporting the labor, making the products, 10 is supporting customer activities, 10 infrastructure. So as we basically accumulate it down, eventually $25 becomes the product costs, but that $25 is consumed by the customers. There was 20 direct to them, plus the 25, that's 45, and the business sustaining. It reconciles in total. Now here's that complex diagram. It's not as complex as you think. It has the 3 universal components, the resource expenses at the top, the work activities in the middle, and then all the costs pile up into the final cost objects in the bottom. Now you need to adjust your thinking. This is not a process flow chart end to end with swim lanes. It's a reassignment network. So imagine if the organization spent 10 million euros in expenditures in January, it will be the exact same 10 million of work activities, and they will pile up ultimately into the bottom 2 right boxes, into the customers and into the business sustaining. I'll talk about that in a second. The bottom cost module, think of it like the predator food chain in biology. Large mammals eat small mammals eat plants. So once we get the costs into the products, and notice also there are people activities and equipment activities. Men and women run machines, machines make products. Men and women drive buses, buses deliver passengers. So assets also do activities. But when we get to the bottom, the predator food chain, the products have been costed, but they are being consumed by different volume and mix by the customers. Also notice there are 2 boxes to the right that are going straight to the customers. Those are below the product gross profit margin line, selling, marketing, distribution, cost to serve. Each of the arrows, think of them as thin straws or wide pipes, where the diameter of the pipe reflects the amount of money being consumed. That's why this totally reconciles from the top to the bottom. Business sustaining is a special category. There will be expenses that have nothing to do with making products or delivering services to customers, things like the legal department or the salary of the CEO. So we create a special category there called business sustaining. We put cost objects there like management team. And so that prevents us from over costing or allocating to the products or customers. Direct costs, that is not broken. You may have data integrity issues, but that can be solved. Now, I mentioned, because I went through that stage, that diagram so quickly, many of you may say, I didn't understand what Gary said. Here's the answer. Go to this link when you receive the PDF. It's a 30-page statement of management accounting that I wrote for the Institute of Management Accountants. What's important, though, is what's the consequence when you do ABC? So the vertical axis in this diagram is the magnitude of the error between ABC and the traditional butter spreading. So the horizontal line, see, it's got traditional costing. That's your traditional butter spreading. But when you do ABC, it's the curvy line. So let's start at the left side. These are the simple products that basically have been overcosted. It's like you in the restaurant ordering the salad and the other three want you to split the check evenly. If you did that, you'd be subsidizing them. But to the right, those are the complex products and services that cause much more of the indirect expense. So in reality, they've been undercosted. What's the consequence? From the left side, when you've been overcosting it, you're confused. You basically think you're making money when you're not. So competitors can basically price their products and services, let's say 5 or 10% below your price, and start grabbing market share from you. But on the right side, it's worse, because what happens there is the sales force thinks they're making money on profit margins on products that they think are profitable, but in reality, they're unprofitable. So the more they sell, the more the company loses money. This diagram shows also the consequences, and you're looking at real data here. This is typically referred to as the whale curve. Notice its shape looks like a humpback whale. The vertical axis is the net revenues minus the properly traced and calculated ABC cost. The horizontal axis is the cumulative buildup of each product, starting with the most profitable product, the second most profitable product, and so forth. The very last data point at the right will exactly reconcile with the P&L for the company. So in this example, this is not an example, this is a real company, it's a folding chair company. It's an organization shocked when the management team sees it, because it said, look, you made roughly $8 million of unrealized profit on 3/4 of your most profitable products. You lost $6 million on the remainder to net out at 2. And they usually cannot believe it, because their belief system before ABC is this graph would be this little blue line with a little hook at the end. And, oh, a few of our products are unprofitable. What's happening here is the ABC system is detecting all the diversity and variation of all those outputs and tracing them. So the top line is reality and truth. The blue line is false. Now, some of you may be saying, what do you do with those unprofitable products to the right? Do you drop or abandon them? No, that could be a mistake, because sometimes we have deliberate loss leaders, products that are priced below the cost, but they're associated with winners. So like a men's shaving, blades and razors. You sell the razor at a loss, but you make up your money with the razors. But the reality is about this whole slide is, remember this, in the absence of facts, anybody's opinion is a good one. In the absence of facts, anybody's opinion is a good one, but usually the biggest opinion wins, which is the opinion of the boss of the boss of the boss. So to the degree they are making decisions on gut feel or intuition or flawed and misleading information like the blue line, your organization is at risk. Here's a quick example of another one of the diagrams. The companies losing $500,000, but they're making almost 8 million on 60%. Incidentally, the two graphs you just saw were my very first ABC implementations in the early 1980s. They're almost 30 years old. Yet many organizations are not doing ABC. Now there's more here that meets the eye. If you look at just at those products that are on the downslope, what you're at in the graph, what's actually happening is each product is reaching up into the work activities and asking, how much of each of you did I uniquely consume last period? And it piles them up vertically like pancakes, where the thickness of the pancake reflects the quantity of the driver times what's called the unit level cost consumption rate. And we'll get to that later. And so what ABC gives is the visibility, the transparency that has always been hidden with that butter spreading cost accounting. I love this cartoon. The sign says answers. To the left, simple but wrong. To the right, the path is complex but right. Look how many are taking the left path. Yes, it's simple to basically allocate overhead on labor hours and what have you, even though the actual costs are wrong. Very few take the path to the right. Our purpose of this presentation is to start persuading many of you, take the path to the right, do activity-based costing. And I want to give some empirical evidence that very few organizations do ABC. I present webinars for training firms for CPE, continuing professional education. And one of my polling questions, you have to do polling questions, after I've explained what I just explained to you, has them answer this question. How do you do your cost accounting in your company? A, only direct material and labor without overhead. They think that overhead is fixed, so don't even bother. B, product costs with just a single overhead allocation. C, product cost with multiple overhead cost pools using ABC. Yes, C, that's it. I just described it. D, even going into product profitability. They click the radio dials, look at the result. 93 out of 100 are still doing it the old way. So it's empirical evidence. People are not using ABC, but they should. I love these two quotes. It is better to be approximately correct than precisely inaccurate. In other words, it's better to be roughly right than exactly wrong. I also like to say, in the land of the blind, the one-eyed man is king. Some of you may be saying, Gary, you're beginning to persuade me that we should be doing ABC at our organization. However, it's my belief that it's a mudslide of data. There'd be 3,000 activities in that monstrous, huge, complex system. Every employee would have to fill out a timesheet, and employees hate filling out timesheets, and on and on and on. And that was a problem in the 1970s, 80s, 90s. It still is. When people implemented ABC, they wanted precision, so the models were too large, too complex. No one could understand them. They collapsed under their own weight. They were not maintainable. I came up with the technique, and I can describe this too if you want to send me an email, called Rapid Prototyping with Iterative Remodeling. It starts with a one-day workshop, model 0 to the left, with 5 or 6 cross-functional employees in a room. You build a high-level model very quickly. It's not intended to give any accurate information. It's basically intended to say, this is what it will look like. And the next day, you bring in the line managers and the executives. They see the model built by these employees. The light bulbs go on with everybody. Oh, that's how we get rid of that butter spreading. Oh, that's how we could see our profit margins accurately. Oh, that's how we could do benchmarking with apples and apples, not apples and Oreos. So on and forth. They get it. They understand the value of ABC. Then you do a couple of iterations. Within 2 to 3 weeks, to the right, permanent, repeatable production system. As I say, make your mistakes early and often, not later when the system is too hard to change. Why does rapid prototyping work? It has to do with this diagram. The vertical axis is the accuracy of what you want to know. Let's say it's a product cost. The horizontal axis is the level of administrative effort to collect the data, calculate the data, validate the data. Notice you'll always get an asymptotic curve. The accuracy will go up relatively quickly, and then to the right, diminishing returns and extra accuracy for the extra level of effort of work. Rapid prototyping allows you to get this big black line. Notice the slope goes up very quickly, stops at 95%, and then it turns to the right. Well, then stop at 95%, good enough. You know, this is management accounting. It's not external financial reporting for compliance and statutory reporting. You know, if you get the statutory reporting wrong, you go to jail. But if you get the management accounting information wrong, you don't go to jail. So just get it good enough that you can give information to make better decisions. Is the higher climb worth the better view? Benefits from ABC rapid prototyping, accelerated learning. People get it. It solves the thorny leveling problem. How many activities should we have? 3,000, 2,000? Typical ABC models have 50 to 70 activities. It prevents that over-engineering of the model, which led to the collapse and failure of ABC. Also, at the end of the second day, I asked the managers, the executives in the room, in 3 weeks, when you see this completed model, how will you use it? One person may say, I can validate my pricing. Another, I can basically look at what our processes cost and so forth. We're getting them to commit to use the information once it's available. So now let's move on to another part of the 3 lessons. Going below the product gross profit margin line, meaning the shift from being product-centric to customer-centric. The value of a company is a value that comes from its customers. The only value a company will ever create is the value that comes from its customers, the current customers and the new customers acquired in the future. To remain competitive, one must determine how to keep customers longer, grow them into bigger customers, make them more profitable, serve them more efficiently, and acquire relatively more profitable customers like your existing profitable customers. We have a couple of problems. The CFO and the accountant are not calculating customer profitability. What's the problem? The problem is they are stopping above the product gross profit margin line. Products and standard service lines are not the only thing which accountants should compute costs for. What about all the costs that have nothing to do with making the products and delivering the standard services? The problem with traditional accounting's product gross profit margin reporting is you don't see the bottom half of the picture. And by bottom half, I mean below the product gross profit margin line. And I'm going to make a case that the bottom half is more important than the top half. Visually, what I'm saying is if the entire rectangle here is the total expenses, let's say for January, February, the accountants are only calculating costs for the shaded spot. But what happens when we expand to the channel, and to the customer? The white space, distribution, sales, marketing, general, is more important than the shaded space. Why? Here are 4 reasons. I call this the perfect storm. First reason, customer retention. It is relatively much more expensive to acquire a new customer than to retain an existing one. Well, this is a no-brainer. Why? Because if you understand decision theory, you only include variable expenses in the future. So existing customers, you already got them. So they're a sunk cost. You don't include them. Next, sources of competitive advantage. As products and standard service lines become commodity-like, then the shift is towards service line differentiation. What I mean by that is in most organizations, customers do view the products as commodities. Banks, everybody views depository accounts as the same. Next, customer relationship, one-to-one marketing. Martha Rogers and Don Pepper, they are gurus in the marketing space. They've hailed technology as the enabler to identify customer segments and tailor marketing offers to them. So they're saying work backwards, knowing the unique preferences, traits, and characteristics of customers, and tailor the price discounts, the coupons, the offers, the deals to them. And finally, the power shift. The internet is shifting power irreversibly from sellers to buyers. And I don't mean you and your household with your family buying things on the internet. Today, a purchasing agent in a company can see a whole list of suppliers and all the prices and costs that they offer. So if you take these 4 forces and many more that I didn't list, you realize it's the bottom half is more important than the top half. Now we have another problem with ABC or with traditional costing, angel customers and demon customers. What's the message here? Every company has high maintenance and low maintenance customers. Example of high maintenance customers, always changing delivery schedule, always buying special, not standard, always calling help desk, always returning goods. Low maintenance customers, the angels, we love them. Never change schedule, never buy, you never only buy standard, never call help desk, never return goods. If those two types of customers at polar opposites bought the same volume, same mix, same price, they are not equally profitable because the high maintenance, the demons are causing you much more work and they're basically less profitable. What really caught my attention in this book is not the main title, but the subtitle. Discover which type of customer is which and turbocharge your stock price. And the message here is customers are the source of financial value creation for shareholders and owners. We need to connect them together. Incidentally, this book is written by marketing faculty at Columbia University in New York. It doesn't really refer much to management accounting. So here is a decomposition of the ABC multi-stage cost assignment network. I'm not going to go through it. It's in the 30-page document. But when you bring in the activity drivers left to right, what's happening is layer by layer by layer by layer, you are eroding the profit. And this allows you to get a profit and loss statement for each customer. And it gives layers of profit margins like in an onion skin. And in this fictitious example, for one of the customers, they had a 30% gross profit composite average margin. But between the 30 and the 8, 22 more points of profitability are eroded, nothing to do with making the products or delivering the standard services, but all with distribution, selling, marketing, and so forth. And if you calculate those two broad swaths for every customer, you can put them onto a grid that looks like this, where each circle is a customer. And the vertical axis is the product mix gross profit margin. The horizontal axis is the cost to serve from low to right. In other words, the angels to the left, devils to the right. And now things become obvious. The most unprofitable customers are in the lower right because they're buying low profit margin mix from you and they're difficult to serve. The most profitable customers are in the upper left because they're buying high margin mix from you and they're easy to serve. And now the name of the game is the actions to move the dots from the bottom right to the upper left. And that would be a different webinar from a marketing person. But an example that they might give you is unbundling and fee base. Like the banks, they started charging for depository accounts. Airlines in the US, they'll charge money for baggage or if you want to move from a middle seat, to an aisle seat. Also, this is very early stage, but some companies are changing the sales commission of the sales force from 100% exclusively sales volume to their bonus and incentive commissions to a blend of maybe 60% customer sales, 40% customer profitability. And now the salespeople realize I've got to take some actions to alter the behavior of my customer in harmony with our organization's expense structure to make them more profitable. And so by doing this, we're now basically getting the driver of the salespeople to basically increase profitability to reward the shareholders and the owners. In this diagram, I've replaced the circles of customers with squares. And now in this diagram, the vertical axis is the profitability of the customer. The horizontal axis is the sales volume of the customer. Notice the square to the farthest right, that's our largest sales customer. But above it is a few customers, a little less sales, more profit. Look at the triangle at the bottom. Here's a bunch of customers that have high sales, but they're unprofitable. The message here is sales volume is not a proxy for profitability. So what's really happening here is there is a shift in the emphasis of the CFO. The CFO must now help sales and marketing to better target the customers. The spending budget for sales and marketing is critical, but it should be treated as a preciously scarce resource to be aimed at generating the highest long-term profits. This means answering questions like, which type of customer is attractive to newly acquire, to retain, to grow, or to win back, and which types of customers are not attractive? And for the types of customers that are attractive, the next question is, how much should we optimally spend attracting, retaining, growing, are recovering each customer microsegment. And the reason I have optimally in italics is because it does become an optimization problem. Why? Because if you remember the subtitle of the Angel and Customer book, to discover which type of customers turbocharge your stock price, you can destroy shareholder wealth in two ways. The first way is overspending unnecessarily on loyal customers for what is needed to retain them. You know, you wind them, dine them, or you treat them well, they would have still bought the same volume and mix. But you can also destroy shareholder wealth by underspending on marginally loyal customers and risk their defection to a competitor. So therefore, what is the optimum spending level for differentiated services to different microsegments? What I mean by that, for each segment, and some marketing departments may have 20, 30 segments of customers. You don't want to overspend. You don't want to underspend. You want to just get it right. The CFO and the accountants can provide this information to sales and marketing. If you are interested in supply chain management, I did recently co-author a book with 2 university faculty at the University of North Texas. It's called Supply Chain Costing and Performance Management. The link to it is down there. Now let's talk about how to basically manage costs. What I just described to you already is the strategic view. Now, how about the operational view? One of the approaches is lean accounting. Now, I do want to warn you that lean accounting can be, you got to be careful. Some consultants only say lean accounting is the only way, do not do ABC. The good news is lean accounting can coexist with one or more other costing methods. And to read more about it, I'll show you my next 2 slides. I did write an article. It is in the link that is in this slide. It's called Lean Accounting and Activity-Based Costing. Is it a choice or is it a blend? And the answer is, it is a blend. Why? Real briefly. Here's a simplistic diagram of the multi-stage cost assignment network. Each of the X is an activity in each of the departments. For activity-based costing, strategically, we reassign using the activity drivers to the products, types of orders, and customers. But we can also sequence, string the activities like pearls in a necklace, end to end, to look at the individual processes. And what the lean management community does is they like to string them, and they've then produced something called a value stream map, where this is now, the activities are now in a process flow view. The vertical axis is the amount of the spending, and then they will then tag or score each of the activity as value added versus non-value added, and so forth. So this allows them to start focusing on where can we reduce cost, where can we reduce cycle time reduction. It provides the visibility. Also, we can use what are called attributes. We can tag or score the activities. So for each activity in an ABC system, look at the first diamond. Question is it required by a customer? If not, can we eliminate it? If it is, can we reduce the frequency of the driver? I mean, imagine we're delivering to drugstores 3 days a week, Monday, Wednesday, Friday, okay? Or excuse me, 7 days a week, partial skids, partial, truckloads. What if we go just 3 days a week, full skids, full truckloads? We reduced the cost, or we can score or tag them as value added versus non-value added. I'm going to skip this one in the interest of time. Let's now move to the predictive view. Remember my what, so what, then what? The then what is the way to go. So the next 2 slides are going to be in the presentations that I will be doing for the ICMA Sri Lanka on July 21st, a week from now, and on August 4th. But I want to give you just a quick preview for those of you who will attend those. Question is, why is the budgeting process broken? The budget is typically a fiscal exercise by accountants that has 2 problems. 1, it's disconnected from the executive team strategy. And 2, it's not based on future driver volumes. It's not volume sensitive. So let's see how many of these answers you would answer for your organization. At your organization, or if you're with a CPA firm or a consulting firm, imagine this is one of your clients. And also, if you are a CPA firm or you are a consulting firm, please directly communicate with me. I can share and train you how to implement ABC and even strategy map and balance scorecard for your clients in a very quick and effective way, which will then provide you add-on work. Because once your client goes through the shock of seeing all the problems, they're going to ask you, can you help me fix it? So I can help consulting firms and CPA firms how to implement these. So let's go back to the question. At our organization, our budgeting exercise is invasive and time-consuming with few benefits. Next, it takes 14 months from beginning to end. Well, maybe 6 months. It requires 2 or more executive tweaks at the end. After you publish it the first time, the executives say, not good enough, I want more profit. Go back and change some of those spreadsheets. Next, it's obsolete in 2 months due to events and reorganizations. That's why, since the budget is out of date so quickly, we need to move to driver-based rolling financial forecasts. Next, it starves the departments with truly valid needs. In the next fiscal period, there may be a department that's going to have a bigger workload, but we only gave them maybe a couple of extra employees. They really needed 15 or 20. Next, caves into the loudest voice and political muscle. You know, this is those gray hairs, the bald-headed people, the veterans, 50 years or older. They're the sandbaggers in the next one. They know how to pad the budget as cushion just in case something goes wrong next period. Next, it incorporates last year's inefficiencies into this year's budget. You know, our process was inefficient last year. We replicate it this year. The one that bothers me the most is the very last one, because when a manager is 3-4 months from the end of the fiscal year, and they know they're not going to have spent all of the budget that was approved and allotted to them, what do they start doing? They start spending needlessly, foolishly. Why? Because they know that, like in a spreadsheet, their next year's fiscal budget is going to be pegged to a baseline of how much they spent this year. We call it use it or lose it spending. When I talk in those 2 presentations, I will share how this can all be solved. But it does get tricky, because when you go to the predictive view, you've got to think like an engineer. Remember, you know, my degrees were industrial engineering and operations research. When I was 27, I was a division controller for FMC Corporation, a large conglomerate. But I always tell people, I think like an engineer, not like an accountant. And here's why. In the historical view, it's basically just costing, you're calculating cost. But in the predictive view, budgeting, rolling financial forecasts, what if scenarios, you need to classify the behavior of each resource as sunk, unused capacity, fixed cost, fixed expense, step fixed, or variable. And you'll notice that as the time horizon goes from short-term to long-term, variable costs become increasing. Why? That's because in the short term, you can't easily adjust capacity. But as you go out weeks, months, years, for example, you could replace full-time employees with temporary contractors. You could lease assets that you would have bought. It becomes microeconomics. So you've got to think like an engineer. To start concluding, remember IFAC, the International Federation of Accountants, that I created that taxonomy, remember the 3 kingdoms, tax accounting, external financial accounting for compliance, statutory, and internal management accounting. I also created for them a stages of maturity report. You can download it from the IFAC module. And here's an example, or here is what's in the report. And incidentally, at the bottom, it says source. If you go to ifac.org and just basically search on their website, you can download this report, or it's also in my website at www.garycokins.com, or send me an email. I will email you the report. All right, how does it work? In the historical view, there are 8 stages. In the predictive view, there are 5 stages. Here's the reality. 95% of organizations in the historical view are at a 5D or lower. They are doing that butter spreading of indirect expense. Remember the 94% in my polling question. Moving up to 6D is starting to use ABC for product and service line costing. 7D, going below the product gross profit margin line, customer profitability. Incidentally, back to the consultants and the CPA firms. If you contact me, I will share with you how you can go into your client. And of course, any one of you listening to me that's in a company with the same paper, in one day, you can determine which of these stages are you at. But back to the consultants and CPA firms. If you do this, if you do this for your client, you can basically schedule it the day before the board of directors meeting and get 30 minutes on the board meeting time and show them your 5D. And I will tell you, all the board members will look at the CFO and say, how come we're at a 5D, not at least a 6D? It's a kind of way of shaming them. This is a way to get the motivation. There again are my ABC quotes. To start concluding, what's really happening here is the ROI basically is shifting from basically a monetary buying machines, trucks, or software to the return on investment of an intangible asset like information. And you'll notice that the ROI from intangible information increases exponentially as we go left to right, from data to information to knowledge to insights to decisions. The problem is many organizations are stuck in the first two red bubbles to the left, raw data and standard reports. All they can answer is what happened. In some case, the IT director in the third bubble will give some managers some drill down software like Click, Tableau, Microsoft Power BI, or from SAS, my previous employer, to basically drill down to see an outlier line item of an invoice or purchase order. Okay, but they're still restricted to only answering what happened. Corporate performance management methods, including management accounting and ABC, starts at the first blue bubble. It's modeling. Remember, costing is modeling. Remember the multi-stage cost assignment network way back, with all the piping, basically costing is not key accounts and journal entries, it's modeling. So when we're in that bubble, we not only know what happened, we know why did it happen. Then when we go to the predictive modeling, the forecasting, rolling financial forecast, budgeting, driver base, we not only know what happened, what can happen. That includes what if scenarios, capital budgeting, and then we get to prescriptive analytics, kind of Mount Everest of all the choices we could make. What is the best choice? So real quickly, and then we'll get to a few minutes of comments. Why is the adoption rate for profitability reporting with ABC been slow? I'm very frustrated. Remember my whale curve diagrams? I created those in the 1980s, 30, 40 years ago. And the vast majority, and I know the vast majority of you listening to me are not using ABC when you should, and your problem, and I'll just say it now, in India and in Sri Lanka, too much emphasis on statutory regulatory reporting for the government agencies. That's imbalanced. You've got to basically spend more time basically providing good, valid information to your line managers and employee teams so they can make better decisions. So what are the barriers slowing the adoption rate? Well, one of them are technical barriers that are IT related. They include dirty data. We call this, poor input data. But there are tools that the IT function can use, like extraction, transform, and load ETL. It's a software package to purify the data. Also, in larger companies, they may have multiple hardware vendors, Dell, IBM, Hewlett Packard. IT can fix that. The next barrier is the perception barrier of excess complexity and affordability. I believe that the majority of you listening to me came into this webinar saying, oh, Gary's going to talk about ABC. It's not worth the effort. It's too complicated. That's because your perception is it's too messy. It's too big. It's too complex. I demonstrated to you, you can implement ABC in 2 to 3 weeks, all the way to include customer profitability. But the real barrier has got nothing to do with processes. It's got nothing to do with software. It's got nothing to do with systems. It's got nothing to do with ABC method. It's all about people. It's organizational behavior. It involves resistance to change, culture, and leadership. The problem there is resistance to change, a major one. Most people love the status quo. Only babies like change, changing their diapers. Other concerns, fear of other departments knowing the truth. Oh, I don't want the other department to know which product is truly more or less profitable. Also, fear of being held accountable, fear of being measured. And finally, weak leadership. There, I said it, not every executive team has the highest IQ, So if you want to successfully implement ABC, you need to have some organizational behavior change management skills. But if I was to see all of you and ask, raise your hand, how many of you have degrees in psychology or sociology? No hands will go up. Most of you are accountants. To you, you're like Newtonians, like Isaac Newton. To you, the world's a big machine. Give me the pulleys, dials, bear, you need to think like Charles Darwin, Darwinian. The organization is an organism, sense and respond. Finally, here's another problem. Whoop. The vertical axis is the skill that you acquire as you go through school. The horizontal axis is the stage of your life. Elementary school, you're 5, 6, 7, 8 years old, 1, 2, 3, 4. Oh, now you're in junior high, basic operations, multiplication, division. Oh, now we're basically later in high school, geometry. Whoa, now we're into college, algebra, trigonometric function, complex calculus, advanced calculus. And now you're in your job. Back to spreadsheets. Here are the excuses, and then I'll have time for discussion. Why do people not do ABC? They say, we are profitable. So why does it matter? Well, guess what? You may not be profitable forever. We will purchase software that will fix our problems. Software for ABC is modeling. A fool with the tool is still a fool. It's fancier. It's trickier than putting in an ERP system or a payroll system or a payable system. Next, we already know our true costs from our general ledger finance reporting. No, you know your true expenses. You got to calculate your cost. Expenses and costs are not the same thing. Next, we have done it this way forever. We don't do that here. We already know everything. It's in our heads. No, it's not in your heads. What's in your heads is your intuition, not the facts. Next, we are a small organization. We will worry about better methods when we get larger. Well, guess what? You may not get larger. You may go bankrupt before you get larger. Next, all this hype is just made up stuff from highly paid consultants. Well, let me defend the consultants and the CPA firms, advisory arms of CPA firms. They can do something you can't do. They can focus. You're so busy closing the books, payables, and all the other stuff, you don't have time to basically implement. Next, no one looks at reports I recreate, so there is no point generating better reports. This is sad. Some of you actually are trying hard. You're giving your line managers better reports, and when they get them, what do? They throw them into the garbage can. You got to fix that. Next, we cannot afford better software to fix our problems. The commercial ABC software is not that expensive. Again, if you email me, I can give you a list of 10 commercial ABC software vendors. Now, SAP, Oracle, Infor, the large ERP vendors, they do have modules that do ABC. Next, we are way too busy doing other things. What is that? Closing the books. You take 3.5 weeks to close the books. You take a deep breath. The monthly hamster wheel cycle begins again. You don't have time. That's why you need some of the FP&A software tools to close the books in 1 or 2 weeks, so you've got time to implement these methods. Finally, we don't know where to start or how to get started. I've already showed you rapid prototyping with iterative remodeling is a fast way. The complete vision of performance management. One of my books to the left is integrating performance management with, all of these ideas. In it, I have greasy, grimy, broken gears. What I'm really sharing, and if any of those gears or teeth are broken or they're disengaged, it's going to be bad. If you put that in your car engine, the engine would run, but the fuel efficiency would be low. The future vision is to the right. These titanium gears spinning faster revolutions per minute, digitized, lubricated. Put that in your car engine. Now what's your fuel efficiency? Much higher. Now replace the analogy of fuel efficiency with rate of shareholder wealth or owner creation. It goes up more quickly. Your success depends on how well and how fast the right information intelligence gets to the right people. Action steps: get educated, You're doing that. Thank you by being here. Rapid prototyping, start small, think big, think about incentives. I have 2 links there to resources you can read. The last slide is, I think, 6 articles that I've written. They're also in my website. You can download and read each of them. And so, Lakshman, I know I went a little bit longer, but we do have a few minutes. So how would you like to proceed?
Gary, I think, thank you very much. I think it was a very detailed, and also, of course, you went quite fast, but I'm sure that everyone would have followed it. So what I will now do is I will hand you to over to Dr. Nuan, because he will be handling the Q&A session, but also our panelists now. I invited a few of them. If you all want to ask any questions, please raise your hand. Then Dr. Nuan will be able to direct to you and then ask the question. So over to you, Dr. Nuan.
All right. Okay. Thank you, Professor Whatever, and also thank you, Gary, for this interesting presentation as always. Yep, we have got a couple of questions on the Q&A box. Let me also quickly add few Sri Lankan perspective, Gary, just to make this whole thing complete. As we all know that the application of management accounting techniques in the Sri Lankan context is very low. So that I think this is not common to Sri Lanka. I think it's common to the entire region as well. And also what is important is that when these management accounting techniques or the tools are used for very few purposes, like budgeting and controlling, including variance analysis. And on the other hand, the new management accounting techniques such as although you can't call them new, but techniques such as ABC, life cycle analysis, and also sustainability management accounting techniques are used inadequately both in the private as well as in the public sector. And also, as Gary mentioned, there are so many barriers for the low level of application in management accounting, especially a few of them lack of manager awareness. Then again, emphasis on financial accounting for decision making. And then the other one is the inadequate development of accounting infrastructure. That's where we can benefit from, IT. Then again, the other approach is the fourth reason is that primitive approach to costing. When you have a butter spreading approach, you forget about the causality and your costing becomes a very simplistic approach. So this is the common situation both in the public and the private sector. So with that very brief overview on the Sri Lankan perspective, let me move on to the questions. Gary, one question is that to manage the activity cost, would it be advisable to start with the major activities and then go down to the activities that are of less importance?
First of all, I believe you should always do enterprise-wide. So the scope of the ABC model should be the entire P&L from the previous year, starting with that. So that's the scope, the size, get every single expense in it. What your question is really about is what we would call decomposing or disaggregating. And my mention is, here's a simple, don't put activity costs on tasks. Think of tasks as little steps. Just keep it limited to 50, 60, 70 activities, maybe 3 activities per department. That's part of the problem. The accountants want to get too detailed with too much precision. So what I call right sizing it. Instead, I want to make a point though. When you introduced it, you said, Gary, thank you very much for my talk. It's very interesting. I'd like to say interesting or relevant. There's a difference.
I think it's both.
So of course, relevant would be, I hope some of you listening to me tomorrow, when you go back to your job, you think about what I said today. Next question.
All right, Gary. Okay, the next question is interesting question about today customers are asking for guarantee periods. So how do we assign? Customers are asking for a guarantee period. When you sell a product, they might ask for a warranty or a guarantee. Product warranty or a guarantee. So how do we assign these costs, because we don't know whether they would occur or not?
That's an interesting question. It actually starts introducing what's called the cost of quality, which I did not talk about in my presentation. And again, if you do go to my website, I have written articles for the American Society of Quality, And it's a way to tag each activity as prevention, appraisal, internal failure, external failure, and the like. And of course, that's the spectrum for cost of quality, conformance and non-conformance. And that fourth one, external failure, includes warranty and liabilities. You can maybe estimate how much warranty and liability expenses will be incurred in the future year, but I would put them in the business sustaining. Remember the multi-stage cost assignment network with the predator food chain? Create a cost object, which would be warranty expenses, so that you at least have visibility to what they're going to be. You still have to recover them with pricing to be profitable, but that will then prevent you from trying to trace and assign the warranty expenses to any customers, because at that point you don't know which ones are going to cause it.
All right, Gary, thank you. So let me move on to the next question. It says that it's very difficult to reapportion the cost according to ABC. So any advice, please?
Well, I guess I disagree with the question. What he said is it's difficult, and I just need to come back. It's not difficult. It's modeling. It's a skill. It's like, you go from art, craft, science. Think of that as, the artist, craft, science. Artists, they're with a paintbrush. Craft, plumbers, carpenters. What I showed you, the ABC multi-stage module and the whale curve, that's because I have the skill as like a carpenter or like a plumber. I know how to design that multi-stage, and you can, all of you listening to me, you can pick up that craft. So it's not that difficult. And if you use the model 0, the rapid prototyping with cross-functional employees in the room for the day one, you're basically building a high-level model with your craft, just like being a child with, building blocks and Legos and so forth. So I disagree with maybe I misinterpreted, but it's not that difficult.
All right. Okay. All right, Gary. The next question, I'm just, rephrasing the question. So it's about, utility provider, especially, power utility. So what would be the most logical or the most advisable way to identify the cost drivers in a utility provider?
Well, first of all, just to let people know, earlier in my career, I did implement ABC for the Tennessee Valley Authority. In Tennessee, it's a major electronic distributor. And if whoever is in the electrical production, if they want to communicate with me, I can share more. But the question is, how do you define an activity driver? And there's a really sort of simple rule. When you define activities, use verb, adjective, noun, like process invoices, move materials, create automobile loan, verb, adjective, noun. Now for the activity driver, number of the noun in the activity. So, process automobile loans, then the driver is number of loans. So even with the utility, the activity dictionary, we call it, defining the activities is the starting point. And then you say number of whatever the activity is. Now you can get a little more granular, because when I said number of invoices, well, maybe number of domestic invoices, number of international invoices, because then an international invoice is more costly, expensive to process. I will then have the driver number of international invoices. So again, in my ABC book, or if you look, how you define activity drivers is the answer to the question that you just asked me.
Okay, thank you, Gary. The next question is, when you apply ABC, would there be changes depending on the industry? For example, in the manufacturing, then finance, banking. So would there be changes according to the industry?
Well, it actually starts at the beginning. Each ABC system is tailored like a men's suit of clothes or a woman's suit of clothes. So you're basically, oil and gas, banking, insurance, travel agency, manufacturing, each one is going to have their own unique model. So now if the question is actually when processes are changing over time, I don't think that's being asked, but I'll answer it anyway. You then start modifying the activity dictionary, or as processes change, the driver quantities will begin to change. So it's sort of dynamic. The model is not static. It's static, for the last period, but you're constantly, if you will, revising the model. So you could almost think, gee, it's moving towards actual costing. Next question, if there is one.
Yes, yes. We have one question from Professor Chandrasri, one of our panelists. So what he says is that in Japanese cost accounting considers no direct labor cost to be identified. Instead, only direct labor cost and overhead, including labor cost as conversion costs. So this further supports ABC to consider all conversion cost as overhead, disregarding the existence of direct cost. So what's your idea about it? That's what he's interested to know.
Well, in reality, what ABC is doing with the indirect expenses, it's making them direct. If you think of the multi-stage cost assignment network, the diagram with all the piping, it's taking the indirect, but because it's using the cause and effect principle, that's the costing's universal principle, it's converting the indirect expenses, directing them to the activities they support, and then sequencing through. So in effect, ABC becomes an enterprise-wide direct costing system. It's just you're converting the indirect into the direct.
Okay. One last question is that what would be the ideal cost driver for the cost of vehicles, for example, fuel and maintenance used by the technicians? So should we use kilometers or man hours? What would be the ideal cost driver?
Well, again, the activity dictionary will give you, so if we're maintaining vehicles, let's say doing a tune-up, you would be taking the worker team's salary and expenses and look at, let's say, the 3 activities they do. Let's just keep it simple. They rotate tires and they do a tune-up. That's it. So when we say, well, how much time do you do in a typical year? Well, 80% is doing a tune-up, 20% is changing tires. Well, now we get their salary expenses into those. Now comes the activity driver, number of tune-ups, number of rotating tires. So the activity driver is, number of rotating tires. It's modeling. Hey, before we go, well, I do like the phrase, but does any of the panelists want to make any comments? Typically in the past, you had some feedback from some of the panelists. I know we only have 3 minutes, sir.
Yes,
yes. Tiral is having a question.
Yes, basically what Gary said and what Dr. Nuwan said, I think most of the Sri Lankan companies are now starting to use ABC because of the volatility. They want to identify the areas that are not giving value to remove them because of the present volatility in the Sri Lanka. But anyway, I think this is a good program, and Professor, I propose that we should have a ABC training program to our accountants, maybe a hybrid program using Gary and us physically, because most of the accountants just want something to give them and start this process. And of course, as I said, as Gary said, if you are using tier 1 software systems like SAP, you can easily go into this because they have built-in analytics and building cost centers, activity drivers. So I think these are the things that we have to bring to the Sri Lankan accountants. They are hungry for this kind of stuff to come out. I think it's a high time that CMA organizes a program on activity-based costing, because it will be the first, and people are hungry to do that. And I also asked Gary if you can give us or share with us activity-based costing sheet of a service sector like a bank or something, so that we can share with our members. It will be very helpful. Thank you.
Okay, thank you. But first, Tyrell, I want to correct something or challenge you. You started by saying most organizations in Sri Lanka are not doing ABC. My challenge is do a survey. I'll bet you that only 10% or less are actually doing it. So it wasn't most. I think what you're really saying is the need for ABC is escalating with time.
Correct. I agree.
Professor Chandrasiri Abesingha, would you like to make a comment? Because I think you have already implemented activity-based costing in an industry.
Okay, thank you very much. And thank you very much, Gary. It was a very excellent and very interesting advanced presentation. I'm very happy about it. And actually, one point I would like to make is that now what you explained was basically the application of ABC. Now, I think when we are going to implement an ABC system, what I find is that the base issues are like identifying activities, activity cost drivers, and driver rates. They are what I found one difficult area is identifying, because converting financial data, because normally accounting data are available in item wise financial data. So bringing these financial data into identified activities is a kind of a difficult area as I experienced. So I would like to see your experience and your advice on that, Gary.
Well,
thanks.
I hate to repeat myself, rapid prototyping. That model zero, that first day, before they come in the room for each cost center, I have them predefine 3 activities. So if there's 10 cost centers, 3, that's 30 activities. So we're actually starting. And because the purpose of model zero is not accuracy, after it's done, then the next iteration, well, which one should we change? Maybe we should replace this one. Maybe we didn't describe it. Make your mistakes early and often, not later. So you're evolving, you get to fix it better. So, but I know we're past the 90 minutes, and I think it's a professional courtesy to not go beyond what people are expecting, although I appreciate almost everybody attending has stayed here, but I think we should probably stop the webinar. And I welcome, you talked about a training. I mean, I can do a 4-hour workshop on how to implement, how the rapid prototyping techniques works, but it's always a pleasure and an honor to present for ICMA Sri Lanka. And I do want to mention, I know what's going on in your country. We see that in the USA News. You have problems. We have problems here in the USA, but the good news is for all citizens, babies will always cry. There will always be rain. You'll see flowers come up. Life will be good in the future. It eventually is all going to work out.
Thank you. Thank you very much, Gary. I think we are very thankful to you. We are also mindful of the time, because I know that we should finish it, and a lot of them would like to finish on time. But let me once again thank you, Gary, for the very valuable time that you have spent with us. And as was suggested by Tyrell, who's on our Cost and Management Accounting Standards Board, certainly we will maybe follow up what you also agreed, maybe a 4-hour workshop. I think that would be a great exercise, and I'm sure that we can get Professor Abesingha and Dr. Nuwan involved in that exercise, because they are both closely involved in this area, plus of course Tyrell, who's in the industry and doing it. So thanks very much again, Gary, and also for those very encouraging remarks regarding the country, the economic situation. We all hope that maybe we will, as professionals, that we can play a role in this, because what we really find is that these have been done maybe in a different way, or not implementing or not making use of the great work that you have been doing, which we can implement. So I'm sure that what we are doing now would certainly be useful, and that we will be able to train more people in this area. And as you always say, the value addition, and to look at the value added people who are adding value and those who are adding, who are not adding value. I think that I think is the biggest component, which maybe need to turn into the value added. So thanks very much, Gary. And as you mentioned that there are 2 more webinars that you have agreed. And I must also thank Shanti. She's been really maybe helping you and then getting everything done. All the arrangements and everything. So, and also all of those who are present here, our panelists, and also our members who participated for this event. And I'm sure it will be very useful. But let us maybe take this forward and take it to the next session of the training session. So thank you, Gary. And it's morning there, it's night here, and I hope that when we wake up the next morning, we will be in a better position than today. Thank you very much, and all the very best. And good morning
Thank
or good day for you. Right? Thank you. Thanks,
you.
Dr. Nuwan and all the others, Tiril and Professor Abhay and also from our side to Shanti, Kosala, and all that. Thank you, and all the very best. Thank you.
Thank you.
Bye.
Right. Good night.